Candlesticks are the purest form of price action, that provide a visual picture of what is occurring in the market, and suggest the future movement of prices. Candlesticks give a lot of information, and you must learn to read them the same way you read the words of a book. The study of candlesticks is a very ancient discipline that developed in Japan, to be able to understand the future trend of the financial markets. Japanese traders used candlesticks to analyze the first Dojima rice market. Candles can be bullish or bearish. Both candles have an open, close, high and low point. The highest and lowest point of each candle is always the same. The shadows are the highest and lowest lines of the candles, also known as the tails, or wicks. Let's analyze some of the basic candlesticks that you will find on the chart. These type of candles indicate a tie between buyers and sellers. No one has managed to dominate over each other. These type of candles indicate that buyers were in control of the market, but sellers managed to impose themselves, and pushed price back down, regaining control of the market. These type of candles indicate that the sellers were in control of the market, but buyers managed to impose themselves, and pushed price back up, regaining control of the market. These type of candles represent a strong continuation of their respective trend. Doji candlesticks are one of the most important, representing equilibrium between supply and demand in the market. These candlesticks give a clear trend reversal signal, and it is really important to be able to identify them. Doji candlesticks have a small body that appears as a thin line, and also have the same opening and closing price. This indicates current indecision by the market participants. When a doji is formed on the chart, you must give special attention to the preceding candlesticks. You must also understand if price is fluctuating near key support or resistance levels, or if it is following a strong trend, for a major confluence to enter the trade. Doji candles indicate indecision, meaning that neither buyers or sellers were able to gain control, with a result that is essentially a draw between the bulls and the bears. The candle moves quickly in one direction, or in both, and closes very near to the opening price. There are four main types of doji candles: the long-legged doji, the dragonfly doji, the gravestone doji and the four-price doji. The long-legged doji has a long upper and lower shadow which is almost equal in length. This doji represents a balance between buyers and sellers, and if found near resistance or support levels, it could indicate a potential reversal. The dragonfly doji has a long lower shadow, and indicates that sellers moved the prices lower during the session, and by the end, buyers pushed price back up to the opening price. It has a very small or even absent upper shadow. The gravestone doji is the opposite of the dragonfly doji, and it has a long upper shadow and an absent lower shadow. This candle shows that buyers moved the price up during the session, and by the end, sellers pushed price back down at the opening price. The four-price doji has no upper and lower shadows, and if it does, it is really short. This candle is very rare and gives rise to potential trend reversals. This candlestick is mainly found in the lower timeframes. It is important to always ask yourself specific questions when observing the charts. What is the candlestick closure communicating to me? Does it confirm or contradict the previous candles? Did the candle break above resistance or below support? Does the candle confirm my analysis? Understanding what price action is telling you is the most important part of trading.